Hey there, if you're looking for consistency with your options trading, you need to consider and learn about vertical spreads. Vertical spreads are the most versatile option strategy out there, and they're really the foundation of some of the more complex spreads such as iron condors, butterflies. You probably heard of those before, but I'll admit they can seem a little intimidating at first. So in this video, I'm going to break them down into a few kind of simple to understand concepts that will hopefully remove some of the complexity that you might have seen when looking at these type of spreads, so you can start considering them in your trading. And I'll also add that the vertical spreads are by far the most consistent option trading strategies that can be used in both up, down, and sideways markets. So before we get started, don't forget to subscribe to this channel and check the description for the latest option trading giveaway. And let's go ahead and dive in here. So what is a vertical spread? And we're going to start with just a few bullet points here, and then we'll dive into the platform and kind of look at some of this stuff in action in the option chain. So first of all, a vertical spread is a simple concept. All you're really doing is you're buying and selling the same type of option in the same expiration month. Okay. So for example, you'll for a call vertical spread, you would be buying one call option and selling another call option in that same month. Or for puts, you would be buying a put option and selling a put option in the same month. And vertical spreads can be both bought or sold. There are really only two types of vertical spreads. There's debit spreads and credit spreads. And we're not going to get too deep into that side of it yet. We're just still trying to go over the vertical spread part. But basically, a debit spread, there's two types of debit spreads: a bull call spread and a bear put spread. And the debit spread is the one that seems to make the most sense to people, where most people associate calls with being bullish. So a bull call spread is a bullish call spread, and a bear put spread is a bearish position where typically when you buy a put, you're bearish on a particular stock. So a bear put spread. So a debit spread, the name sort of goes with the direction of a call and a put, that most people think of. With credit spreads, it's kind of the opposite. So if you sell a credit spread made up of calls, it's a bear call spread. And vice versa, if you sell a credit spread made up of puts, it's a bull put spread. So it kind of reverses the direction of that particular option. So, but again, the main concept here that I want you to come away with is that there's only two types of vertical spreads: debit and credit spreads. And then of those, there's two types of debit spreads, two types of credit spreads, and that's all there is to vertical spreads, as far as just understanding how they're sort of constructed. So now let's go ahead and dive into the platform. So I'm in Thinkorswim now, and I'm looking at the option chain for SPY, and we are at the end of the day, so we're still during the trading day, so some of the prices will be moving around a little bit. And we're just going to kind of simply look at the front month options, and we're not going to worry about the Greeks or any of that stuff. But right now, I'm just looking at the plain option chain. You can see that all the strikes are in order. There's some half strikes, some not half strikes. And in Thinkorswim, to help make this a little easier, I'm going to, right now it's under single, so we're just seeing single options, but I'm simply going to drop this down and choose vertical. And now you can see in the option chain that it combines two different strikes. And that is basically what a vertical spread is. Remember, you're going to, in a call option side, you'd be buying a call option and selling a call option, and a put, you'd be buying a put and selling a put. Now, what I'm going to do to make this a little easier is I'm going to drop this down and do a deep and wide 1 month 4 strike vertical, just to spread it out a little bit. So that way the strikes are a little bit farther apart. But essentially, it's still the same thing, where you see that now we have two options which make the spread. And the reason why it's called a vertical spread is because it's two options on the same side of the option chain. So if it's calls, you'd be buying one call option and selling another call option, but they are vertical in relations to themselves. So same thing with the put. You'd be buying a put and selling a put, and in the option chain, if you go back to single, those options would be vertical to each other. That's why they're called vertical spreads. That's all that word means. A vertical spreads means you're going to buy a call and sell a call in the same expiration month, like we talked about. And a put spread, you're going to buy a put and sell a put in the same expiration month. And that is what essentially is a vertical spread. So let me change this back to deep and wide. We do a 4 strike vertical, and that's sort of the distance between the strikes. So I'm just going to kind of look to buy a vertical call spread. And you can see this ask. If I want to buy the call spread, I'd click the ask. If I wanted to sell it, I would click the bid. But let's just do a buy spread here. And you can see that it automatically puts this spread in order. So +1, which mean I would be buying the 244 call. And at the same time, I would be selling the 246 call. So when this is a bull call spread, because it's a debit spread, and remember in our previous slide, we had a debit spread with calls is a bull call spread. So you're buying a call and selling a call. It's still a bullish position. Now, if I went back to the same, if I do the same spread, but this time instead of buying, I sell it, it's still a vertical spread, but this time I get the credit. So this is a bear call spread because I'm selling a call and buying the same call, but I'm receiving a credit. And a credit call spread is a bearish position. And again, we're not going to get too deep into why you would do this and choosing strikes, but just to understand that if you buy the call spread, it is a bullish position. So I'm going to flip this up. I'm buying the call spread, but if I sell a call spread, it is a bearish position. So let's do a put spread real quick. Let's just kind of go at the money here. So if I buy a put spread, it's a debit, so a debit put spread is a bearish position. But if I sell it, I would get a credit, and that would be a bullish position because it's the puts, kind of like opposite. So you may have to refer back to the slide to kind of go through the bullet points again, but that's all a vertical spread is. And in a future video, we're going to talk about when you would do a bull call, bear call, and all that stuff. But I just wanted to go over the basics here. So make sure you subscribe to the channel. I got more videos come out on these types of trades. They really are the most consistent options trading strategies out there, and they really are the foundation. So stay tuned to the next video, and I'll see you next time.